I'm going to get started. What we're going to cover tonight, the major provisions of the One Big Beautiful Act, better known as the OBBBA or OBBA. It applies starting in 2025. So your tax returns that you're filing by April 15th of this year, it's going to impact those tax returns. We're going to go through some of the items that are, what's new, what's now permanent that we weren't really sure what was going to happen, some planning items that you might be thinking about before the tax season starts. We were going to do this earlier, but now for some reason, all the 1099 seem to be pushed out mid-February. So we thought, around this time, most clients would have most of their tax documents. It would be a good time to, provide this to you. Again, one last time, feel free to drop your questions in the chat as we go. So just a brief overview. This was signed into law of July 2025. It made significant individual tax changes, and it's going to be applied to those returns that you're filing this year. The big focus is really tax rates, deductions, worker incentives, and some new savings options that are going to be available. There's changes now to enhanced deductions for seniors, no tax on tips, no tax on overtime, no tax on car loan interest. What does this all mean for you? We're going to go through all of that. Most of these items, there's a new form called the Schedule 1A. Again, happy to send that to anybody that really wants to dive into tax code, but it gives a breakdown of each one of these items that I'm going to be talking about and how it comes to it. Most of these have income phase outs. Nothing that you have to memorize on here. I just want to make sure that you understand kind of where you stand with your individual situations. Again, this will be recorded, so you don't feel like you have to take all copious notes or anything like that. I'd be happy to share this, the presentation, whatever you guys want, to make it easier for you. So these are the tax brackets that are now made, permanent. Again, you don't need to memorize them, but we give these questions out a lot when we're giving out new account information forms. What tax bracket are you in? And a lot of clients end up not knowing, and that's fine. But here's the different tax brackets. There's, the single filers, married filing jointly, and you'll fall into one of these brackets. The most important thing with the One Big Beautiful Bill Act is that these are now permanent and said they were set to expire, but they're now permanent. So it gives taxpayers and also planners at least more certainty going forward, which is helpful for different long-term planning decisions. I get a lot of questions about Roth conversions. When should I be collecting my Social Security? All these different things come into play now, and we have a lot better vision for the long term to figure out what makes most sense for each client's unique, tax situation and retirement situation. So, again, just as an overview of what those tax brackets look like and where you might fall. For the most part, the clients were, especially the past few years, with the SALT limits, were on the standard deduction. I'm going to get into the SALT limits in a little bit, but the standard deductions still remains very relevant. So for 2025, if you are filing single, your standard deduction is going to be $15,750. For married filing jointly, it's going to be $31,500, and for head of household, $23,625. What does a standard deduction mean to you? It just means that if all of your deductions don't add up to those amounts, you're going to just fall into the category of taking the standard deduction, because you're going to want to take what's ever higher, either the standard deduction or if you itemize, you're going to want to take the itemized deductions. Some of the itemized deductions are mortgage interest, property taxes, contributions that you make, charitable contributions. Those are the different ways that you get to the itemized taxes or itemized deductions. But most people, past few years have fallen into the, standard deduction category. That's why I wanted to highlight it here. The big news, this is kind of the first big change for clients. We already saw a couple of clients this year. It's made some significant impact on their tax returns. It's called the new senior deduction. If you're older than 65 years old, you might qualify for it, depending on your income. Again, there is a phase out. It's the enhanced deduction for seniors. It When the politicians were going through, they were talking about how there's going to be no tax on Social Security. This is that extra deduction that it provides you to kind of supplement and provide you some of that money back. For those that don't know, if you are collecting Social Security and you make over a certain level, usually it's around 30,000. I don't have my notes in front of me and I try not to memorize it because I never want to give wrong information. But if you want it, I'd be happy to share it with you. If you make over a certain dollar amount in income and you're collecting Social Security, the IRS takes up to 85% of your Social Security and moves it over to income, and then you're taxed on that income. So this extra deduction is going to help clients. So if you're married filing jointly, it'll be up to $12,000, $6,000 if you are single. And the phase out for this does begin at $75,000 of a modified adjusted gross income and $150,000 for married filing jointly. Again, that's when it starts. So some people have been getting some of the benefit, not all of the benefit. Again, this could be found on Schedule 1A as well. And this has been, pretty helpful for some of our clients that usually end up owing because their income ends up being more with the required minimum distributions, dividends, capital gains, things like that. That starts adding to their income, and then their Social Security becomes taxable. So this is actually beneficial for them, and it's definitely helped them out. Some of my younger clients, there's the child tax credit expansion. So it's been expanded and now made permanent. The maximum credit is now $2,200 per child. It has a refundable portion of $1,700, and it's adjusted for inflation. And there are phase out levels. So just like with everything else, you make over $200,000 single, you make over $400,000 married filing jointly, it starts to phase out. These are more permanent now. And again, just so that you know, a deduction will reduce your income. So if you make $100,000 and you have $20,000 of deductions, you're going to be taxed on the 80,000. Credits are a lot more powerful because that's dollars that you get in your pocket. So if you're getting a $2,200 tax credit, you're getting your taxes reduced. Whatever your taxable bill, if you had a bill for $5,000 and the credit was $2,000, you're going to get a reduction of you're going to get a reduction of the 2,000, so you'd only owe 3,000. So again, $5,000 tax bill, you get a credit of 2,000, you're going to only owe the 3,000. So a tax credit is a lot more powerful than a deduction. So anybody with children, something definitely to make sure that you're getting the full credit for your child. This is another big one, especially for all my clients that live in New Jersey, Bergen, Passaic counties, Union counties, Connecticut, New York. In years past, they had a SALT cap, which is the state and local tax deduction. This was at $10,000 and they just increased it to 40. So again, a lot of people were not itemizing in years past. So if you decided that you weren't going to itemize in years past, you might qualify for itemizing this year, especially if you do have property tax and everything else. Now it's increased to $40,000. There's another phase out though. If you make over $500,000, there's the 30% reduction. This is huge. So if you weren't, including your charities and everything else, because your accountant said, "Hey, don't worry about that. You're just going to end up taking the standard," and you live in a high tax state, a high property tax state, the itemized deduction might be on the table for you this year. So again, SALT cap raised to $40,000 from 10,000. Huge difference there. So something to be, looking out for, especially this year. I think this is one of the biggest things, at least for us New Jersey folks, that could benefit you. There's some new worker focused deductions. There's no tax on overtime, no tax on tips. These are, and a lot of these are the politicians really push them. But what does it really mean, just to go through it? So I would say the tips aren't as applicable because most of the people that I know that are in the industry of tips, They're probably not reporting it, but right now you don't have to worry about it. For clients that do want to make sure that they're, including their tips, including their, all that on their tax return, it's a benefit to them. Also, there is a new, of course, income limits. There's new reporting requirements. It's on the Schedule 1A, again. Um, I would say that this year, most of the W-2s that I've seen and come across do not have any sort of overtime listed on there. Next year, starting in 2026, or actually this year, but when you file for next year, it's going to be mandatory that on your W-2, it's going to include what your overtime amount was. So if you are a someone that makes overtime, you're going to want to go to your HR or at least pull your last pay stub and find out how much you actually paid or how much you made in overtime. And it's not the full overtime amount. So I'm going to give another example here. If you make, let's say, and I like using easy numbers, let's say you make $15 an hour and now you make time and a half. That's 22.50. So you're not going to be taxed on the 750 difference. So if I take 22.50 your time and a half and I subtract out the $15, you're left with 750. If you worked a total of 100 hours that entire year, you're not going to pay any tax on the 750 times the 100 hours. That's not going to be taxable. But the portion that you were earning, the time portion that you were earning, that's going to be taxable. So it's only that portion that's actually not going to be taxable. Again, it's not mandatory on the W-2. So this is something that if you know you earned overtime last year, take a glance at your W-2. If you don't see anything that says overtime, I would just make sure that you're including your pay stub so that the accountant or tax preparer could figure out, how much of that is going to be a deduction for you that you're not going to owe tax on. So something else that, is could be applicable to a lot of people. Maybe not so much to retirees, but people that are still working, if you're earning overtime, something that's definitely helpful. Some other worker-focused deductions. There is the auto loan interest. So anybody that purchases a car assembled in the United States from 2025 to 2028, you may be eligible for your loan interest deduction up to $10,000. Again, this is one of those weird ones. Just be careful. There's a lot of specifics. I don't want to go through all the specifics, so always, check with the manufacturer, your accountant, everything else. The vehicle's got to be assembled in the United States. The gross weight has to be less than 14,000 pounds. There is a income phase out. So if you're earning over $100,000 and you're single, you might not be eligible. And if you earn $200,000 married filing jointly, you also might not be eligible. So again, if you bought a car, it was assembled in the United States, it's something that you might want to consider, or making sure that you're bringing it up to your accountant at least, and that would be included on your statement. When you go, you can get an annual statement from your loan provider, and they should show year to date from 2025 how much you paid in interest. Up to $10,000 could be deductible for you, and again, that's on the Schedule 1A. This next slide is really not part of the one big beautiful bill, but it was introduced just this year, and I've gotten a lot of questions on it. So I just want to make sure that we're clear on this. The retirement contributions continue to adjust for inflation, so you could see under 50, age 50, and then age 60 to 63. Something new for this year or for 2025 is there's that super catch up. This was part of the Secure Act 2.0. So if you're from the ages of 60 to 63, there's an additional catch up. Everybody's used to the age 50 plus catch ups, but the age 60 to 63 is something brand new or it was new last year. Again, not part of the one big beautiful bill, but if as you're going through this year and if you're in that age bracket and you're still working, you could actually increase your catch up contribution. It's not applicable for traditional and Roth IRAs, but for 401ks, 403bs, simple plans, 457s, all those, they do have that provision in there. And then another one that is kind of an offshoot to this, but if you earn over $150,000 a year and you contribute to a 401k and you're maxing out, and then you're doing a catch up, you are going to have to start putting that catch-up contribution into an after-tax Roth IRA. So you're not going to get the benefit of the tax deduction on that catch-up contribution, but it could go into a Roth portion. So I would say I probably had maybe a half a dozen clients or so reach out and say, hey, does this make sense? Have you heard of it? Yes, across the board. If you're earning over $150,000 and you're doing catch-up contributions, that after that catch-up contribution is going to go into the after-tax Roth portion. So I would still recommend doing it. It's still good for you doing, the Roth portion. But something else that's, come down that's different for this year. Um, New children savings vehicles, the Trump accounts. So this is something brand new. I've again a lot of questions on this. It could be for parents and grandparents. So I know I've gotten a lot of clients that if they just had a kid last year, it's on their radar. But if you're a grandparent and maybe you want to fund it, maybe you don't like the 529 college savings because you don't want it earmarked towards college alone. This is a slightly different plan. All of the information is still kind of pending. There's actually trumpaccounts.org website that you can go to, and it has all the information there. But I just want to take a moment to just go through it. So these are after-tax savings accounts for children. Sometimes they're referred to as Trump accounts. These are scheduled to be launching like summer of this year. And if your child was born in 2025, and I think to 2028, that's what I've read so far, is they are going to be eligible for a seed contribution. So you might have heard the news that Michael Dell and his wife were donated a whole bunch of money. So if you open these accounts and your child was born between that time frame, they're going to automatically get started with $1,000. The other thing is, I know I asked our broker-dealer, Cetera, if they're going to have these available for our clients, and they will, but they're working on them. All the details still aren't standing. You could open these accounts for any child under 18 years old because once they turn 18, it's really their money, and they could take it out at that point in time. So who can contribute? Family, friends, employers. So some employers out there might be offering this now for families. So the maximum contribution is 5,000 per year per child. It could be invested in, low cost index type funds is what it said on the website. And what can these funds be used for? So it has a little bit more flexibility than the 529. So it could be used for education. It could be used for a first time home purchase. It could be used for starting a business. Those are the three main areas that you could use it for. The form is 4547, kind of easy to remember. And so if your child was born last year or 2025, there's a tax form 4547 that we could use to open that up. And there's also going to be an online portal this summer that is going to be eligible for it. The website that they have is a pretty good resource. And that's just another planning tool, another savings vehicle for children. Or grandparents that maybe they want something for their kid or grandchild. If it's not used for those things, then it becomes taxable. They didn't really go through. Is there a 10% penalty? Those are the things that I was looking for. So this is still this is brand new, and they're still working out some of the details. Kind of TBD on this, but I just wanted to give you some overview of the account that is available. So I kept this meeting pretty close to, I want to leave time for questions, everything like that, but I'm going to give an action checklist. Just 5 quick things, confirm your eligibility for senior and child credits, review your tax withholdings, any sort of new deductions, gather your overtime, tip income for documentation. Now this year, more than ever, evaluate SALT versus standard deduction, and also reach out to us. I'm happy to help with any questions that you might have. Answer them, and point you in the right direction or provide guidance on all this. And finally, thank you for coming on this In New Jersey, it's a rainy, Wednesday night. And I guess just a couple of housekeeping items, some questions again that I get a lot. Is referrals, are we accepting new clients is one of the things that I always get. Yes, we are accepting new clients. There is a place on our website. There's a refer a friend. So if you do have anybody that, hey, you could put their information there, we'll get it. So we are accepting new clients. So I just wanted to point that out. The other thing is we do use service at ELA Financial Group. We really pride ourselves on providing the best service. So if you send it to service at, it goes to all of our staff members and it gets rolled out to the correct person. If I don't have to necessarily give you the answer, somebody else can. So we could, I'd be, I want to make sure everybody's aware of that. The other thing is social media. We do a lot of these quick short videos on taxes and retirement plans and all these things on different social media accounts. So if you want to see shorter versions of this and you don't want to just hear me talking for 25 minutes, our Linktree, where if you just want to take a picture, it's on our business cards, I believe, and happy to share these links out. But it has, our website if you want to schedule an appointment, our Facebook page, Instagram, all those different things. Just a quick landing page that has all of our links here, so you don't have to go searching our website for, where do we find this, and all of our social media is on the side here. So some of the questions. One was about anything we need to submit for 2025 taxes. I'll follow up you separately on there. If you're a salaried worker making 40,000 a year and a 2025 W-2 shows 50,000 because 10,000 was overtime, wouldn't you just get an adjustment for it? You could, but I would rather go off of the actual tax. I'm sorry, I'd rather go off of the year-end pay stub, because sometimes on a W-2, especially for New Jersey, it shows gross of $50,000, but your federal might show 45,000 because they don't take into consideration some of your retirement plan contributions and things like that. So that's why the W-2 isn't necessarily showing what that overtime is, or it could be sick time, things like that. But the pay stub is where it would show a line item for overtime. So that's why I would rather use the line item for overtime. I don't know if anybody has any other questions. Those are the only questions that I had. Again, I wanted to be mindful of time and kind of go for 30 minutes and then, open it up for questions.